Good morning, everybody. Welcome to the Flow Show. It's Friday. We're here at last. Well, at least it's not Friday the 13th. Hey, fellas and girls. Joking, of course. It is Friday the 13th, so be careful. Morning, Kay. Got your lucky rabbit's foot on your desk?
That's what went wrong then today in my positions because it's Friday the 13th. Oh, dear.
Yep.
Good morning, Ryan. Good morning, everybody.
Yep, it's definitely Friday the 13th if you believe in that sort of thing. Yeah, not me, but you never know. Right, lots and lots to get through today, so I'm going to get cracking and try and get through it as quick as possible. PBOC fixing still 718s, no change there. Then there's been don't know if it's a bit of a pushback or shall we say a bit of clarification on the currency story that we had here this week, that they might allow their currency to weaken. Official headlines from the PBOC, not sources, say they are going to enhance exchange rate expectation management, and they will resolutely prevent the risk of the exchange rate overshooting, and will deepen FX market reform next year. So, as I say, it doesn't sound like they're going to do anything untoward, but it was still a little shot across the bows nonetheless. That hasn't stopped new US trade advisor Navarro, one of Trump's old team members from last time. He said that the new administration would not look fondly on any attempt by China to manipulate its currency. So that was the reply to that sources piece this week from the US side. Anyway, China finished their economic power meeting, whatever thing they had this week. President Xi has basically just come out and reiterated what we knew already. They will implement more proactive macro policies and will implement cuts in interest rates and reserve requirement ratios next year. A bit of data out of Japan and more Tankan survey stuff. This one is Q4 numbers, so a bit of an outlook sort of data. The standout one is the capex, or one of the standout ones is the capex, so investment, big industry investment. That was up, or expected to be up 11.3% at the index, that is. Beaten expectations, 9.6 was expected to fall, so that's good news, shows potentially the willingness of firms to invest. A ton of other numbers out as well. This one is probably the most important one, large manufacturers index, that rose to 14, which is the highest since it posted 14 in March 2022. So a lot more positive looking than we saw in the monthly number yesterday. So this is Tankan is something that this is actually a BOJ survey, so it is something they pay attention to very closely, and it's all looking pretty good, at least for Q4. We did also get some industrial production numbers. If I can find it, there we go. Miss of expectations, 2.8% month on month. Was expected to come in at 3%, but still a decent rise over last month, although capacity utilization is looking a bit softer at 2.6%. Reuters have been polling again. Apparently the BOJ is going to hold its rate at 0.25% next week. So say 58% of economists, that's up from the 44% in their last poll in November. So a bit of a flip there between thinking they will hike to thinking they will hold. 51 of 52 of those polled say that the BOJ will raise rates to at least 0.5% by the end of March. They've also got some indications out for wages. They expect next fiscal year's wages to come in around 4.7%, which is less than the 5.1% this fiscal year. Good news for the UK. More good news for the new government. Absolute crappy numbers coming out across the board. GDP for the month showing a negative minus 0.1%. Was expected to rise 0.1%. Year-on-year number coming in at 1.3%. industrial production, construction, manufacturing, all coming in with some really soggy numbers there as well. So no good news, as I say, for the new government since the budget. The ONS did note, because these numbers are for October, that there is potentially a bit of budget effect in there. So some people are looking for a bit of a bounce back next month when we get the November details. We shall see what that brings. This is the first run of a lot of UK data we're getting between now and the Bank of England next week. So if it continues like this, then expect the market to ramp up cut calls going into next week, and we'll see what that brings. Just on that stuff so far, Kay, we're going to be playing a pendulum game now. Now we're past all the other banks. It's going to be pendulums for the BOE, I think.
Yeah, exactly. And I must say, well, yeah, as you say about the budget, but we also know, to talk about markets, how emotional the market can trade sterling, and it definitely, and me included, and us included, by the way, we were also looking positively at the sterling, but we can see how rapid things change. We're talking about how the 82 would be tackled or attacked pretty soon in euro sterling, and it only needs one set of red colored data to well, not to completely reverse everything, but to put a serious dent in sterling's strength. So I guess the market running a bit long sterling as well. We'll have to see what the next set of data will bring, because they can completely veer the other way around again. But it is one of the risks that we have been talking about as well, or with the new Labour government, that how long will the honeymoon last? Get another set of relatively weak data next week, and a Bank of England which is forced to be erring a bit on the dovish side of things, and sterling could actually all of a sudden lose its shine, right?
Yeah.
So that is something that we need to always bear in mind when we're trading sterling, is that the market can flip on a dime in this currency.
Yeah, and it's been particularly valid after each of these central banks have passed. We seem to get, because of the time of year and everything, we seem to get a little bit of a power wash afterwards. You know, whatever the market was positioning going in, that sort of washes out when the facts are known, and then it moves forward to the next central bank and what's happening there. And then everyone's judging everything, obviously, against the Fed. We saw that with some of the euro moves after the ECB. Yes, mate.
Pendulums, and the pendulums are swinging.
Yep. Yeah, exactly. So that's going to happen again next week. We get a ton more central banks, and expect some funky moves after them all, and then we're really into year-end stuff. So it's going to be, it could be a bit hairy into the latter part of next week, but that's for next week. Let's continue with what's going on this week. So pretty crappy data from the UK, and maybe a bit more to come next week as well into the BOE. Yes, Daresh. Yeah, I'm short right at this level at the moment, 82.97. But when we talk about trading, if there's one thing I try and tell traders to be, is be objective when you're looking at trades, when you're in trades. It's no good saying, yes, I'm short, it's going to 0.82, so I'm not going to think about anything else except that. You've got to be objective. I spend more time worrying about what could go wrong with my trades than what could go right. And so, got decisions to make. It was looking all good when we were trading down here. It's not looking so good today. So now you have to think about what's changed. So, yeah, we said if it couldn't go down, it might be heading back up again, and that it's done. Yes, mate.
But there is the reason why we continuously repeat the way we are trading to the people listening and to the people in our room. If like Ryan and I, we are slicing and dicing. So when we are in a position, we do take partial profits, and that is greatly reducing the risk that we have on any outstanding positions. And so even if things go now against us, we have taken some profits, and but our position is still not in danger. That's the reason why exactly we are doing this slicing and dicing, because you never know what the next morning is made of. And we do get a prime example of it right now. I mean, we've been taking pieces off in down into the 82.30s of our shorts. Now we are back at 83 the figure, and we are not completely wrong, but I mean, we our position is not doing as well as it had, but we are in a quarter of our position also, instead of being like full position and wondering where we are going to cut. So this is not at the order of the day, and this is why I'm always saying, like, if you see partial profits, take them, and if it then continues to go in your way, you can always re-add or let the rest run, and it's and that is keeping your book alive.
Yeah, exactly. Always plan for what could go wrong, and let the rest take care of itself. That's my view anyway. Right, we'll look at prices obviously in a bit more detail shortly. Let's crack on to the ECB. They cut rates by 25 pips as expected. No real shock in any of the forecasts. 2024 inflation came down a pip, but we don't care about that. We're 2 weeks before the end of the year. 2025 inflation got cut to 2.1% from 2.2%. So no real big change to that forecast. Core inflation has been left unchanged, 2.3% for next year. So nothing really in the forecast that potentially would have spooked the ECB into going to 50 at this meeting. GDP growth has been shaved a bit as well, but again, I think shocking 2025, 1.1% now versus 1.3% previously. So nothing real much from the ECB. The statement did drop the reference to being rates still being restrictive, so they're now more balanced, shall we say, not at neutral, but now more balanced. They said financial conditions are easing, but they continue to still be tight. They're not pre-committing to a particular rate path, the usual waffle there. ECB's Lagarde didn't sound like she was enticing anyone to go and buy the euro. She said growth is losing momentum, firms are holding back investment, exports are weak, and demand for labour continues to weaken, with several surveys pointing to fewer jobs being created. So all sounding pretty bearish. Says the recovery also is slower than expected. Then she tried to dress it up a bit by saying the labour market remains resilient and the economy should strengthen over time. Sounds like a bit of a hope trade. Now, as expected, there was a bit of a broader discussion, shall we say, because she said that there were some discussions about a 50 pip rate cut, although all members were on board with their decision. She said that the neutral rate cannot be determined with precision, but there was no discussions on the neutral rate in the meeting, though it is likely, or it's probably a little higher than before. That all said and done, that saw the market actually pulling back on easing expectations. The market seeing less than 125 pips for 2025, and you remember yesterday after the I think it was after the CPI data perhaps, we saw those expectations rising to 158 basis points for 2025. So the market just getting a little bit less dovish, but maybe that's just mechanics of some of the price moves there. And then we got the good old sources saying that a handful of policymakers were initially in favour of a 50 pip cut. That's according to Reuters sources. Some argued the ECB is overestimating growth, which could be below 1% next year, particularly under Trump tariffs. Sources also said that policymakers have little appetite for rushing policy amid uncertainty. So a little bit of everything in there. Bloomberg got their own sources out saying that the ECB is prepared for 2 25 pip hikes at its next 2 meetings. Kay, apart from what she was wearing, which is what I spent most of my time concentrating on, any pickings from that yesterday?
Yeah, those earrings and that remote control was something special yesterday. Yeah.
Yeah, absolutely.
Look, she is extremely non-committal, and that's what I was musing this morning in the chat room. Although she's not a hawk, but she's the most undovish person now at the ECB, it seems, because even the Germans and the Austrians are starting to think that they should remain a bit dovish right now. Yeah, I found her, as I said, so non-committal to anything. Um, she sometimes went to great lengths to explain nothing at all. Yeah, it's either she was confused herself or confusing us, but I didn't learn too much in that meeting, I must say. They did 25 as expected, and the one thing that she said, we are going to know more, not in the coming weeks, but in the coming months. That's, I think, a clear hint at what may happen when Trump takes the seat. So that's probably pushing her to not commit to anything right now. And That's about it, mate. And the market
Yeah.
is as confused as we are. And again, I mean, on the opposite of the sterling, probably running short euros, and we've seen, yeah, we've seen this yo-yo again in the euro dollar, but euro cross is picking up on the other side. So that is also telling us that the market was probably running too short euros, because euro is really picking up against most of the other currencies this morning.
Yeah, very much so. And yeah, it's we had this little bounce off this close to this 104.50, and now it's running in trouble on 105. It's keeping this downtrend going since last Friday's NFP break above 106. So it's still bearish, but take it wider. We're still in this sideways zigzag range. No real reason why that should break, except maybe some the Fed or some year-end flows. We shall see. As usual, it's Friday floodgates from the ECB members. They've all been let off the leash like eager dogs waiting to go out for a pee. ECB's Muller says rates are still relatively high given the economy, and that rates are still holding back the economy a little bit. Kestrel Kazakhs, one of the hawks, says significant reduction in rates is still necessary and a bigger rate cut possible if necessary. ECB's Escriva says it's logical to have further rate cuts in coming monetary meetings. That's probably the choice of the comments from, as I say, the ton of ECB bods coming out this morning. I've not paid attention to half of them. Some Christmas cheer for Germany. Bundesbank has cut growth forecasts again. The 2024 GDP is now seen coming in at minus 0.2%, so a negative year this year. That was versus a positive 0.3% in their prior forecasts. 2025 forecasts have been absolutely hatcheted. They've now seen as 0.2% growth versus 1.1% previously. Pretty much, Kay, this year's gone exactly as we forecast it coming into 2024. No real recessions, but everyone bumping along the bottom, and that's going to continue. Is there a risk that we maybe do start to see deeper contractions next year, or do you think we're just going to keep bumping?
I'm going to tell you, ask Trump, but everybody should hear that it may, right? And I think the risk is really there, because if he comes, he makes his promises hard and goes to tariff everybody except from the happy few. It could be that other economies slow first before seeing a better times. It is a real risk, but then. Okay, US, one can call it kind of an exceptionalism, but we have seen that economies can be resilient even in the face of big challenges. So where we had pointed out that those risks, and Europe for one has been exactly doing that. Is hopping around the bottom. Um, it, it, it is just the case that it can worsen, but we always think that Germany has, for instance, has seen the worst. But then you start with a new political issue in France, and it seems Europe, even besides economic data, just can't get his act together. So I think there's a risk next year as well that we see a deeper problem in Europe, especially if the Orange Man comes in hawkish against Europe, which we have to say that against the UK and against Europe, he's been very quiet so far.
Yeah, and yeah, wait and see. He's never quiet for too long. We know that for certain. So we'll see what happens with that. Right, let's move on to a bit of data out yesterday. Not an awful lot. We had PPI coming in. People have been picking the bones out of this one. In my mind, it was a little bit hotter, keeping the stickiness in play. Not too much variation in the numbers, though. PPI can be a bit more volatile than CPI, but overall, the numbers there, PPI year on year 3%, bit of a jump from 2.6. Core PPI coming in, it was higher, but last month got revised up, but it didn't go down as expected. Month-on-month numbers as they're pointing to positive as well. So sticky. Jobless claims, that saw a little bit of a rise, 21k to 242. Little bit of a change in the continued claims. Nothing to note there overall, unless we're sub 200 or running at plus 300. Then we don't need to worry about it. Mr. Trump, he wants to get corporate taxes down to 15%, apparently, according to reports, which saw a little bit of a rally in the dollar yesterday just on that headline. Would be a positive move if he does that. And again, it brings an issue of, talk about currency wars, you also get tax wars as well. If countries cut taxes too much compared to other countries, then it can get others doing the same thing. So that's yet another slant to things that we're going to have to keep an eye on when he takes the hot seat. Apparently, some of his minions are going to be looking to shrink or eliminate bank regulations and regulators when he takes over. So we're compiling a long list of what he's going to be looking at next year for the US economy and whatnot. So that's going to be big to watch. Kay, anything else or anything in that data you want to note?
No, just to come back on those Japanese data and expectations now. I mean, the data they should have been interpreted as pretty well, but we see again what the market is really trading and what the market was trying to trade before. And as soon as it gets deeper into the market that the Bank of Japan is maybe going on hold, it doesn't really matter the data that come out into the meeting. They may matter afterwards, but we see now again that the dollar yen and all the yen crosses are on the rise. Also, what was interesting of note is that you get a good Tenkan, yet your JGB yields are going nowhere. And as a matter of fact, they even went down a little bit overnight. So we have to be a bit careful what we trade or what we try to trade when we are involved in yen.
Yeah. So as we sit here now, what are your thoughts for next week's BOJ? Obviously, noting that it can change in the next 10 minutes. What the market does. Are they going to hold?
Well, 25 is out of the question, but we've already been discussing that. I thought that there was a chance or a risk compared to market expectations that they may only do like 10 or 15 BPs. I think the chance for, let's say, for a 10 BP is still alive, but clearly has diminished also on the back of those little messages that the Bank of Japan has sent out, likely themselves into the market. Seems that they want to be building in a bit of a pause. Perhaps hoping that other central banks come to their rescue right now, which obviously, when we look at how the yen is trading, is not the case at all. Yeah, I think it makes me think that if they really don't do anything next week, we may be in for a bit of a surprise move there, or not maybe to some not a surprise, but a bit of a move that some people may not like on on the yen after next week, especially if we get in comparison a, let's say, hawkish 25 from the Fed, which I still think is the case, but on the tip of my toes as well. But yeah, I mean, the problem is with Bank of Japan, if they only do 10 BPs, what's the difference? And it's still not going to put their own yields, their JGB market, into a territory where Japanese whales may be really interested to start repatriating money, because that is the time really where the yen is going to strengthen, at least, I'm going to say lastingly, but at least for weeks or potentially months, is when the whales are going to decide to bring money home, because the yields are at levels where they think it is interesting to get back into their own JGB market. That is where the yen will be strengthening. Now, if you hike by 10 BPs, and if your, I don't know, 20, 30 year is not really following the move, that is not really going to push the whales to come back home, is it?
Yeah. Well, that begs another question, because they have talked a lot recently about looking at what the yen's doing in terms of changing monetary policy.
Yeah.
If we're at 155,
Mm,
156 before, after the Fed
mm,
cuts
yeah.
with a hawkish cut, would that level get them thinking about definitely hiking next week
I
as a
think
way
so.
to combat the currency?
I think so. The way that Ueda has been changing from it's not my problem, especially Kuroda was it's not my problem, but then Ueda gradually over the last couple of even meetings, in the statements, FX has been put into the statements, and I do think that somewhere it may push them over the edge.
Yeah. But I mean, I think even if they did a 25 next week, as hawkish as that might look, in the grand scheme of things, it still wouldn't be a big move.
No,
Um,
but no, no,
but
but
it's a more a intention, I think that.
yeah, and also you have to know what a 25 BP move may cause in yen books,
Yeah.
especially for those who are heavily involved in the JGB market. And we cannot forget that, I mean, money managers in general, and then specifically those who who have an interest and are either invested or divested in yen. If you move 25 BPs on on an interest rate level that is only at 25 or 35 BPs, it's a big difference. So some of those money managers' books, they may get that trigger to have to change their portfolios. And so I would not underestimate a 25 BPs at the Bank of Japan is not a 25 BPs at RBNZ, RBA, even Bank of
Yeah.
England, or even the Fed.
Yeah.
A 25 BPs at the Bank of Japan is a big change.
Yeah, I was just about to say this.
Yeah,
People have to have context with this. You know, a
yeah,
25 for the BOJ is like a 50 or a 75 for
yeah.
everyone else.
Absolutely, Ryan.
So
Absolutely.
you've got to look at it in that context. I don't think a 25, it's a 25, it's nothing. For Japan, it's a big deal. So anyway, we've got that to deal with next week. God, we're all going to have to be up for it, aren't we?
Yeah, I think by
Next
the
week.
23rd we will be on our knees and ready ready to just go and have a lie down.
Yeah, exactly. Waiting for Father Christmas to come and give us something nice. Right, that's that then. From the headlines, anyway. We've not got an awful lot coming up today either on the data front. We've got some export prices and some wholesale crap from Canada that no one will be interested in. Manufacturing sales, well, we'll keep an eye on that anyway. Right, markets. Where should we go? Let's have a look at old dollar yen while we're there then, because we are having this push up. I've done a lot of fumbling my trades this week, I can tell you. I was long from 152, and I chickened myself out of it yesterday, as it was looking like it was going down again. Now we're up over 143, 153, up to near 153.50. So this is was a bit of a level. We're going through that pretty easily around the 30s. All becomes for me about this the big old 155 now, Kay. Barring any bits and pieces in the way.
Yeah.
Doesn't look like there's a lot stopping it at the moment.
Just look left a tiny bit, Ryan, into end of November. No, there. Just stick on that thing. Just look a little left. We see that 153.5 zone, yeah.
Yeah.
153.5, 153.70. We had activity there. Okay. Some may try to put some kind of pattern on it, but let's not get into that right now. That is for me a bit the zone. If you break above 153.70, we may see an acceleration into the end of the week, and that is without any US data. I think it is the risk today, because coming out, if you look at the whole thing, if you look at the CBs that we had so far, if we look at the inflation prints that we had so far in the US, you take it all as one package, as I like to do. You end up with again this pretty much the same thing. The dollar is the less dirty shirt, I'm afraid, and we can see it in all markets, and the yen is no exception to it. So we've had several minor breaks higher. Well, everybody talking about the 152, of course, but the 152, then as we can see, we hung around, we tried above, tried back below. Yeah, now I think we are in the next zone of relative importance here in 153, half, three quarters. But I would also look at what's happening on the yen crosses, and then one where people always like to be a bit short of, exactly that one. This is putting in some performance over the past sessions, and I reckon some people are getting a bit forced out of positions there as well, because it's been a popular short. The euro being what it is, and people thinking that the yen would not weaken too much further. So this is one which is also a bit of a risk of follow through on this Friday afternoon, and I think this is where we have to, as I say, look at the whole picture. We come out of it, and all of a sudden, market a bit short euros. That's why the euro is holding up, or euro dollar is holding up, because of the euro crosses, and the euro yen is part of it. So that's where I think lies the risk for the yen to close this week.
Yeah, and obviously a big part of what's going on in it. Well, I say a big part. It might be on the bandwagon again. The bus is US yields pushing up a bit. It's still a bit of a curve move though, if you compare it to what's going on elsewhere. Tends moving a bit more around, a bit steadier in the shorter end. But it's all relative. You get one move in the short end for 1 minute, and then nothing happens. But yields in general, US yields in general, look to have bottomed out, at least in the short term now. We had this messing around this 420, but wallop, and forget the moving averages. They're just on there. We don't do tech on yields, apart from noting the levels, but we messed around this 420 and we're holding it. So that's giving it the springboard back up. I can't see us going all the way back up here unless the Fed is, uber hawkish next week. But we could get back up to maybe the 440s, I think, on this one. What do you reckon?
Yeah, you know what, Ryan? It's again, we're coming out of this thing, and then you see the US yields ticking up, and somewhere defying a bit the laws of gravity on the yield side. The market is again trying to. We were discussing quickly with Mark. Mark was mentioning it this morning, and about those yields and the bond market pricing in less and less cuts again in the US. It's this constant repricing, or Well, repricing, I don't like the term repricing, but it's this constant readjusting of the books on depending on each package of data that we get, which is making things a bit difficult to get a real grip on what's happening in the bond market. I think we are about not too far from the edge of what I would say, like because I've been saying this 420 is probably where we're neutral, and we have to allow for probably 10, 15 BPs around it, up or down. But now we are closing in on the upper side of what I would say this is just still part of normal proceedings and managing the books. It is, yeah. It is
It's
keeping
another
the
pendulum swing, isn't
bottom
it?
as well. Sorry?
It's another pendulum swing, isn't it?
Yeah, yeah,
I
but
mean,
then
we
if you
had
look
this
where we
run,
come from in October, you
yeah,
overshoot in well, you overshoot the 420 in November up to 4.5. Then you come back. We should have stabilized around 420. This is starting to look like a move which is may just carry on until the Fed, and then we will see, of course.
yeah, exactly. So keep lots to keep an eye on. But the yields are good to look at. We've had all of this through the hike cycle, the cut cycle, and everything going on, and you then get to know where the levels are sitting. So that's why they're important, and obviously their influence on the dollar. But it all gets thrown up in the air next week, and particularly into year end. And I'm not looking forward to trading year end actually, unless there's some real big out of kilter moves. I was talking this morning in our chat room, maybe even closing up all the books, any long term, medium term stuff I've got on. Well, all I've got is my Aussie Kiwi, but I might just clear the decks and worry about it next year. Right, I have a quick look at a couple more, and then I'll bang it over to Mr. K. We're messing around. It was looking quite bullish yesterday. A bit of a bounce. That bounce over 0.64, but lo and behold, we couldn't hold it. We're back below. We've headed down towards the lows again. We have pulled up at this 63, 55, 56, 60 area, whatever you want to call it. Which didn't do much the first time around, but it's done something this time around, which looks to be one of those little step ups that I look for when you get buyers down here and then come and park the bus in a little bit higher. So that's what this is looking like. We're up against K's trend line, holding below it for now. So again, just keeping this momentum going, another lower high, but might be we see a similar pattern forming, where we've just got this step up. If we now go on a move up, perhaps test 64.40, that will indicate maybe we're starting higher lows and higher highs, as I pointed out yesterday, much as what we saw in Aussie Kiwi. We had this phase down, then you start getting this step up, and then you start getting a bit of a change in direction, which is still ongoing, much to my angst. So this is the sort of price action you want to be looking for. If you're trading Aussie dollar, we're still in a downtrend, but you want to watch for these little turns, because that can make the difference. If you're short, if you've been shorting it all the way through, this is where you need to be careful now, in case it has stopped going down. Right, Kay, I'm passing it over to you. Please don't look at dollar CAD.
Promised. Promised. So, first of all, let's look at dollar CAD.
Of course.
Nah.
I joke, of course. You can look at it like.
Euro Swiss, first of all, guys. Look, I was showing this yesterday as well on the S&P, and we just went to the resistance line here, and today, this morning, we went, and yesterday as well, already in the late New York session, we went for a retest. But today we broke, and we also broke a little other line that I had drawn here. SMB was so far the most dovish of the central banks, and it's relatively speaking one of the only currencies that did the logical thing, and the Swiss started to weaken. I also think that market must have been somewhere short euros across the board, and now we have broken here, and we are now trading back around the 23.6%. It's looking pretty strong. This could go on for a little while. Just note that we are close to the 100 DMA here, but if you look at the 200, it's way higher. So this looks to me like it may have now broken. We need to hold anywhere between 93.30 and 93.45, I think. If we get a retest, 93.30, 93.45 on the Euro Swiss, and it holds, we can push through. We may not even get it, because it is looking pretty bid, this one right now. So bear this little zone in mind. It could be decisive for whatever happens in the next, well, perhaps until the next round of central banks or so. Although we do have the SNB and the ECB behind us, so this is looking breaky. Dollar Swiss is back through the 89. I said this was a bit of the next level through the prior highs as well. Finally, we made our decision. Then I said, this is decision time. We just tagged it one more time yesterday, and then we went higher straight away. Look at what's happening around here, actually. 89, 55, 60 as well. If we get through, there's a fair chance, looking at how the dollar is behaving in general, there's a fair chance I think we are going for a move up into the 90s. SMB cutting 50, and the US numbers package still looking sticky, inflation, etc., etc. Numbers not really coming down too much. And still at the same time, if you look at the US equity market still being at lofty levels, especially the S&P and stuff. And if you look at some a weak central bank with some positive data still, or sticky data in the US, it is supposed to be a good cocktail for a move higher in things like dollar Swiss. And it's a bit in line with what's happening on the dollar yen, although the S&P and the Bank of Japan are in a different scenario instead for the rates, but they are both very low yielders. And if you think that if you see that the US yields are ticking up, also the European yields have been ticking up a little bit, well, shying away now, but have been ticking up a little bit. This is looking as if we could, the combination of everything, we could push through into the 90s dollar Swiss, perhaps even before this week is over. Who knows? Therefore, we should hold 89, 88, 90, I would say. 88, 90, 88, 85 max. That should hold now for a push higher in the dollar Swiss to end this week. We have to look at the metals, because remember yesterday I said it is possible that we start to see a bit of a correction here, and that's exactly what we got. The correction is pretty rapid. I think people gave up the ghost on gold when we started to move back below 26.90, had this move down. I actually traded this bit a little bit here, bought it around 78, sold it out around 88, so only $10, but just improving the average on my very, very tiny now leftover that I have from these zones here. And again, as we said at the beginning of the show, you know my trading style now. When I open a position, I can push the position, but then I am taking profits on the way up. So very good that I've done it again. I highlighted this 1022 zone. We had like just one little spike through, but then came back down. So caution to be had, and caution was needed. Now we're coming into a bit of a support zone here, and we are actually very, very close on it, 2660. It is possible that we're going to have a look below, because besides euro, let's say, the dollar is doing relatively okay again, and with those yields ticking up, that could be the case for a move down into the, why not, around here, 2640, 2630s. It is possible. That's what I've been saying as well. Be careful. So for the time being, not doing anything with it, but just monitoring the game. Okay. yeah, it is, as I said, just possible that we are going to have a look down here. But then I think if we need to continue, the global pattern, we should start to find support in this zone. That's what I would think. Okay, below there may be a bit of a stop loss city coming and have a deeper move if that would happen. Point of no return for me still 2590s, 2600 globally. That is still my very, very big level. Silver, no different. We finally did find this 32 and a quarter too big, and a bit in line with what's happening in gold. We are correcting. We're in a bit of a zone here now as well, 30 and a half, and then of course we need to pay attention if ever we are going to have a revisited my box here at 29.65.70, 30, 10, 15. That's going to be the big box of support again. Even the longer term, the more medium term, sorry, trend line is coming in around there. So that should be the max, or potentially bad news for silver. Okay, but first things first, let's first see if we get down here at all. Now we know the levels on the top side, they're back at 3160s, and then specifically this 32 and a quarter is going to be resistance again. Deresh, your long euro kiwi. Well, I mean, it's not a bad trade right now, right? It did come back to those levels. It does look a bit. Look here as well. We had this traffic zone, yeah, and it seems that we are building on this traffic zone again. So your resistance is coming up relatively close to here, 132.05, 132.15, I would say, 182, sorry, 05.15. That is something to watch. If that breaks, then it's probably going to have a look at that prior high, 182 and three quarters. Does it have the power? Depends how short the euro market is. I'm not inclined to do much. I know some people are preparing to counter trade quite a bit of those euro moves here, but I don't know. For the end of the week, I may just decide to wait for what's to happen next week, my friend, before I make any new decisions.
Can I ask, Derez,
Yeah.
where are you long from? Where's he long from? Because if you're long from close to this top, then you got some questions to ask. But if you're long from like 81s, then yeah, you might want to be looking at taking some profit into this high while it holds. Like we say, take a bit off. You can always add a bit on if it breaks higher.
Yeah, good point. Okay.
There you go. Nice one. 81s.
Pop. I just want to show this dollar yen, yeah. This zone here. You see what I mean? What I meant when Ryan was showing the pictures. You got lows here, lows here, lows here, highs here. I think the 153, yeah, 65, 75. Keep an eye on it. Could be enough for this move, but if it goes through, I would not. This is calling for 155. If this goes through. All right. What else, guys? Anything else? Oh yeah, Ali. Happy Friday, my friend. You are indeed quite late. I don't have much else to show, to be honest.
Yeah, well, that'll do for a Friday.
Yeah, I think so. Back over to you, Ryan.
Thank you very much. Sorry, Ali, you'll have to watch the recording, mate. That's it for this week. Thank you, as always, for coming here to the Flow Show and giving us your input and following us wherever you can on the socials and whatnot. Don't forget, you can come and join with us in the chat room and get this sort of stuff all day, every day, in between laughing at Lagarde's earrings. Thank you as ever to K-Man for all his stuff this week. Do have a safe and peaceful weekend and rest of your day. And we will catch up with you on Monday. Have a good one, everybody.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.